Hi friends, very good evening all of you. Welcome back. So in the previous session, we have completed IAS 2 inventories. You remember? So all the concepts are completed. I have given you so many additional problems also which are not there in the document I have forwarded to you. We have seen so many examples, so many illustrations, case studies we have seen. And at the end of this chapter, we have 1-2 questions and then MCQs. I think some approx 10-15 MCQs will be there, or normally 20 MCQs will be there. So normally after teaching you the whole concept and problems, I'll ask you to do this MCQs revision. Okay, so today let us see in this IAS 2 inventories what that questions and multiple choice questions are there. Based on that, we'll go further. Okay. So after this, today we are starting with IAS 10, which is events after reporting period. Another small and simple standard, but a standard which has a lot of practical relevance. So when you are working as an accountant or auditor, you will come across this kind of situation many times. This events occurring after reporting period, that is very important from even practical work point of view. When you look at practical accounting, how the accounting has been done in various companies, that is very relevant. Very simple standard, small standard. There are only two things you need to understand: what is event occurring after reporting period, and out of that events, what are the adjusting events which require adjustments to financial statements, and what are the events which do not require adjustment. That's it. Simple standard. But before that, shall we see this IAS 2 problems and solutions? Problem number 1. You have 100 items of a product in stock as at 31st December, which is your accounting year end. They cost you 75 pound sterlings each, and you normally sell them for 110. So what is your cost? 75. What is your selling price? 110. What would be the valuation of your closing inventory of this product as of 31st December? Isn't it LKG question? Isn't it LKG question? Okay, so what is cost? 75. What is net realizable value? From the data given, 110. Whichever is lower is 75. So each item of inventory is to be valued at 75 into I have how much of quantity? 100 quantity. So 100 into 75, that is equal to 7,500 pounds. This is the answer. That's all. Then the next one is question number 2. You have 100 items of a product in stock as at 31st December, which is your accounting year end. They cost you 75 each, and you normally sell them for 110. However, you had to sell these items for 62 each due to change in customer preferences. That means the product has become outdated. This information was known to you when you signed your accounts. What would be the valuation of your closing inventory of this product as of 31st December? This has a very good connection with IAS 10, what we are going to discuss now. This has a very good connection with today's topic. So you are preparing your financial statements. One second. On, say, for example, 31/12/2021, you are preparing your financial statements. Okay, so what is the data? Inventory cost 75. Normal selling price, which we consider as net realizable value, is 110 pounds. This is the data given. However, there is one small change. They said due to customer preferences, there is a change in the demand or customer preferences or technological obsolescence, whatever the reason is, you had to sell them at 68 rupees. So you sold them at 68 pounds. So maybe imagine this happened on 15/1/2022. Imagine this happened on 15/1/2022. But you signed the financial statements on, say, for example, 28/2/2022. You signed financial statements. Accounts were approved on 28/2/2022. Okay, so the crux here is, I know that the selling price is 68. When I came to know this, after the balance sheet date, but before the accounts were signed. So should I consider this 68 as net realizable value? So should I say net realizable value is not normal price, which is 110. Net realizable value in this case is only 68. Can I say that? The answer is yes. Your net realizable value is 68 rupees, 68 pounds only. So what is cost? Cost given in the question is 75 pounds. Net realizable value is 68. Whichever is lower is inventory. So inventory is to be valued at 68. Okay. How many items you have? 100 quantity you have into 68 is equal to 6,800. 6,800 pounds. Do you understand? Nice concept, no? Okay. So this is the question. 6,200 or 6,800? I took 62 it is. I'm sorry. It is not 68, it is 62. So you'll put 62 everywhere. Here also 62. So 6,200. In the question they have given 62, not 68. So please make a note. That's all. That's all. So write down in your notes question number 2. Question number 2. Valuation of inventory, underline. Question number 2. Valuation of inventory. Underline. Valuation of inventory, underline. Under that, 1. Cost is equal to 75. 2. Normal selling price is equal to 110. Normal selling price is equal to 110. In the next line, write down. In general, if no other information is available, in general, if no other information is available, comma, the normal selling price is considered as net realizable value of inventory. Net realizable value of inventory. The normal selling price is considered as net realizable value of inventory. In general, if no other information is available, the normal selling price is considered as net realizable value of inventory. However, due to change in customer preferences, the entity had to sell those units at 62 pounds. The entity had to sell those units at 62. The entity had to sell those units at 62. The entity had to sell those units at 62. This happened before the financial statements are signed or approved. This happened before the financial statements are signed or approved. Therefore, this should be considered as an additional evidence. This should be considered as an additional evidence. To determine NRV on the balance sheet date. Next line. In terms of IAS 10. This is an adjusting event. In terms of IAS 10, this is an adjusting event. Therefore, net realizable value is 62 pounds. Net realizable value is 62 pounds. Value of inventory is equal to 75 cost or 62, whichever is lower, that is equal to 62. 100 units into 62 pounds is equal to 6,000 pounds sterling. 100 units into 62 is equal to 6,200 pounds sterling. That's all. So is this clear? Omar, can you turn on the mic and read this question?
Yes.
Yeah, please read this.
CPA Machines is in the business of procuring a specific type of machine and sells them to international markets. During the year, the company bought 4 machines costing $120,000, $140,000, $130,000, and $100,000 respectively. During the year, it sold only one machine for $140,000 and follows the FIFO method of valuation. Which of the following statements is true? Cost of inventory is $370,000 and the cost of sales is $100,000. The cost of inventory is $390,000 and the cost of sales is $140,000. The cost of inventory is $370,000 and the cost of sales is $120,000. The cost of inventory is $370,000 and the cost of sales is $490,000.
Okay, so guys, tell me the answer. All of you, tell me the answer in the chat box. Omar, what do you think the correct option is? They are following FIFO method. FIFO method means the first item they purchased, they treat that item as sale item, sold item. Correct?
Yes, sir.
So what is the first item they purchased? $120,000, isn't it?
Yes.
So $120,000 machine is sold. That means remaining 3 are unsold, no?
Yes.
So remaining 3, add the cost, 140 plus 130 plus 100. Is it 370?
Yes.
So that should be inventory.
Yes.
Then first one, the machine costing 1,20,000 you purchased and you have sold, no? That becomes your cost of sales.
Yes.
So now you tell me what is the correct answer for this?
Option C, sir.
Option C. So Narsimha is saying option C, correct. Omar is also saying option C, very good. So can we go to next question?
Yes.
Yeah, read this.
Which of the following costs are not included while computing the cost of purchase? A. Purchase price. B. Recoverable taxes. C. Import duties. D. Shipping costs.
Yes, we have discussed in detail about this in the class. And this valuation principle, measurement principle applies not only to inventory, it also applies to property, plant and equipment or intangible assets. So this particular question, question number 2, which is asked in the context of inventory, can also be asked in the context of PPE or intangible assets. So tell me, what is the correct answer? Guys, I am waiting for your answer in the chat box. When you bought inventory, you incurred ABCD expenses. Which one you will not include in the cost? Recoverable taxes you will not include. Purchase price, obviously I purchased, so purchase price is the cost of inventory, no? Imported duty, they are not recoverable, you need to add them. Shipping cost, incidental expenses. So this C forms part of purchase price. To be added to purchase price, I mean, the shipping cost is the cost directly attributable to bring the inventory to the location. So all these things are to be considered as a part of cost of the inventory. But recoverable taxes should not be included, like VAT, GST. Okay, these kind of taxes should not be included. Why? You are eligible for credit, no? So this month you purchased inventory and you paid this tax, say for example $100. In the VAT return or GST return, you will claim the input. So you will get the benefit again. That should not be included. This we have discussed in the previous standards also. Now go to point number 3. Can you read point number 3? Omar, read question number 3, please.
So inventory should be measured at the lower of cost and A, fair value, B, market value, C, net realizable value, D, present value.
Superb. So tell me the answer.
C, so.
C, net realizable value. So have you attended the IAS 2 live session?
No, sir.
Then let me torture you. What is the difference between that fair value and net realizable value?
Net realizable value is the value at which the inventory could be sold or would be sold.
Okay.
And fair value.
Simple concept. Don't worry about it. So we'll try with someone else. Nirmal, can you tell the difference?
The fair value means the value at which it actually means the arm's length price.
Fair value is the arm's length price. Okay.
That is the transactions happen between knowledgeable parties.
Okay.
The inventory need not necessarily be sold at fair value, sir.
No, I told you a different dimension of, the distinction between fair value and net realizable value.
Oh, yeah.
What is that? So you are turning the pages and looking at it. Fair value is market driven value, whereas net realizable value is entity specific value. Okay, so please try to understand the difference in the nomenclature. Okay, fair value, net realizable value. Okay, then one more is also there. Residual value, net realizable value you used. Replacement value. Replacement cost. Okay, now let us try to understand these three things. See, this pen, take this pen. This pen is, say, for example, it is $10 US. No, this is much more than $10 US actually. Okay, say this is $100 US. Okay, so this pen is, say, for example, $100 US. Now, this pen I purchased, imagine 4 months, 5 months back. Okay, today, if I purchase the same pen again, if I purchase the same pen again, what would be my buying cost? How much do I need to pay? If I purchase, if I buy, that is replacement cost. If I sell this particular pen today, at what price I can sell this practically today? At what price I can sell this? So if I am a seller, it is net realizable value. If I am a buyer, that is replacement value. Fair value is any person having this pen goes to any active market. So some Tom, Dick and Harry, some John Doe, he has this pen. Okay, so he goes to a market, need not be a geographical market, need not be a virtual market. It can be, he is putting in Amazon and selling also, or he is selling in his physical store also, or he is, taking it to particular geographical market and he is selling also, whatever it is. A knowledgeable buyer, a knowledgeable seller, when they come together, no one is forced to buy, no one is forced to sell, no one is threatened, no one is under the pressure. with a good knowledge about the technology and this pen, one without exploiting the other. In general, in perfect market conditions, what would be the purchase consideration for this particular stylus, for this particular pen? That is called fair value. That is the reason fair value is called arm's length transaction. Fair value is called arm's length transaction. You understand? So, net realizable value is entity specific. Fair value is market driven. So, what difference it makes? For example, if my marketing skills are superior than your marketing skills, if my marketing skills are superior than your marketing skills, I will sell this at 105 US dollars, and you will be able to sell it only at 98 US dollars. Isn't it? Isn't it? But the fair value for any person, it will be 100 US dollars only. Net realizable value changes from entity to entity. Fair value wouldn't change from entity to entity. Fair value changes from market to market. Fair value changes from market to market. Okay, we'll discuss more in 13, accounting standard 13. We'll see about this fair value concept and all. Fair value changes from market to market. For example, I have Microsoft shares. Okay, if I sell it in New York Stock Exchange, for example, I'll get say $60. Okay, imagine, I don't know where are this stock markets in US. Okay, so I'm taking New York Stock Exchange, or I'm taking UK Luxembourg Stock Exchange, or I'll take California Stock Exchange. Okay, so here it is $62. This is fair value in New York market. This is fair value in California, New Jersey, some other place. So fair value difference happens from market to market. But in the same, I'll give you one more example. See, National Stock Exchange, TCS is trading at 2,821. Bombay Stock Exchange, it is trading at, same TCS is trading at 2,834. So for 1 million or 1 crore, 100 million, 10 million, how many buyers and sellers are there? Whoever is operating in NSE, this is the fair value. Whoever is operating in BSE, this is the fair value. So from Pavan to Nirmal, Nirmal to Omar, Omar to Nazar, Nazar to Narsimha, fair value will not change. Whoever buy, whoever sell, this is the price. From NSE to BSE, amount might change. Okay, all this is, learning is fun. Okay, when you have more and more intricate knowledge, learning is fun. When you have intricate knowledge, learning is fun. Actually, in IAS 2 inventories, no one will ask you, hey, did you learn replacement cost? Did you know what is NRV? NRV they will ask, did you know, what is the difference between fair value and all these things? But this is in the academic interest of a student. It is in the academic interest of a student. You should know this terminology and jargon. Then you will enjoy the subject in a better way. Okay. Normally, if I am a trader and manufacturer, I am a trader and manufacturer. Okay, imagine I manufacture product X using raw material A. So this is my production. So I'll take raw materials and I'll produce this finished good X. Okay, now this is manufactured and sold. Now imagine I have raw material A which is used in this. At the end of the year, I have 10,000 pounds of or 10,000 units of raw material A, and I have 5,250 units of product X. While calculating net realizable value, here we take estimated selling price is net realizable value. Here replacement cost is net realizable value. Why? Simple. in my life, I never sold raw material here. I never sold raw material here. What I do? I normally buy raw material, manufacture product X. Buy raw material, manufacture product X. In my life, I never sold raw material A. In my life, I never bought product X. I never bought product X. Product X I sell. So product X I sell. Raw material A I buy. So reverse never happens. Reverse never happens. That is the reason for raw materials we use replacement cost. For finished goods we use net realizable value. If I buy, replacement cost. If I sell, net realizable value. Khatam. See how interesting subject is. So guys, do you understand all these concepts and do you understand the answer for this question number 3? If you give a thumbs up, we'll go ahead. Okay, very good. So, Omar, can you read question number 4?
Yes, sir. The estimated selling price in the ordinary course of business, less any completion costs and costs of sale, is called A, fair value, B, market value, C, net realizable value, D, present value.
Superb. Tell me the answer.
Net realizable value.
Correct. Net realizable value. Very good. I appreciate everyone who is answering in the chat box. Okay. The beauty of class or the beauty of understanding explores more when you are participating. When you are not participating, you even do not understand whether you are following the class or not. I really appreciate if you are answering. I need answer from every student. Only few students are answering. So can you go to question number 5? Read it, ma. Omar, please read it.
Which of the following costs must be expensed under IAS 2?
Okay.
A, costs of purchase that are paid to the suppliers of raw material. B, import duties on raw materials that are paid to the authorities. C, variable production overheads that are allocated to each unit based on actual usage. D, selling and distribution overheads incurred in the ordinary course of business.
So they are asking you which of the following cannot be included in the cost of the inventory, which of the following is to be expensed to P&L. Purchase cost, import duty, production overheads, selling and distribution overheads. So which one cannot be included in cost of inventory? Selling and distribution. Isn't it? Abnormal expenses, selling and distribution expenses, administration expenses that are not directly incurred for production. All these things have to be expensed of. Okay, next, read question number 6.
Vendor Limited had inventory with the cost of $10,000 at the end of financial period 31st December 2013. It is estimated that the net realizable value of this inventory was $9,000 at 31st December. 1 week later, the inventory was sold for $7,000. If the financial statements were finalized on 14th February 2014, what value should be assigned to this inventory?
Don't you think this is something similar? I'm sorry to disturb you. Don't you think this is something similar to second question we have done above?
Yes, sir.
Yeah. So the options given are 10,000, 9,000, 7,000, none of the above.
Yes. Option C.
So what is the option, guys?
7,000.
Correct. Everybody is giving correct answer. Okay, very good. Then read the next one.
Shaw and Co. imported raw materials from China worth $100,000. They paid $8,000 as import duties and $2,000 as import taxes. They paid $15,000 for transportation. The import taxes were subsequently refunded by the local government. They paid $15,000 for transportation of the material from China and another $2,000 as port handling charges for loading the materials at China. Marketing expenses were $1,000 and the general administrative overheads amounted to $2,000. What will be the value of inventories as per IAS 2?
Superb. Tell me the answer. So that first 1 lakh, this 1 lakh, $100,000 is there, no? Can I include that in inventory?
Yes, sir.
Obviously, that is inventory. Purchase cost.
Yes.
Then paid 8,000 as import duty, non-refundable. Can I add it?
Yes, you
Yes. So 108.
taxes.
108. So can I add this $2,000 which are refunded later?
No, sir.
No. Then what about 15,000 transportation? Can I include that?
Yes.
Yes. So 108 plus 15, 123. Is it right?
Yes, sir.
Then 2,000 port handling charges. Can I add this?
Yes, sir.
Okay. 123 plus 2, 125. Then can I add marketing expenses $1,000? Selling and distribution, marketing expenses, we should
Yes.
never include in inventory. Marketing expenses should not be included in inventory. So 1,000 you cannot include. Then general administrative overheads, no. So answer should be $125,000, which is C. Correct?
Yes.
Correct. Very good. So one more question we'll do, and then we'll go to another standard. So can you read 8th question?
Yes. Under IAS 2, fixed production overhead should be allocated to items of inventory on the basis of dash production capacity. A actual, B normal, C abnormal, D estimated.
Tell me the answer. Guys, tell me the answer in chat box. As per IAS 2, fixed production overheads should be allocated on what basis? On actual capacity, or normal capacity, or abnormal capacity, or estimated capacity? You might have done this in costing and management accounting also. Normal capacity. Correct answer. Very good. B, normal capacity is correct answer. So when you are manufacturing a good, actual raw material consumed, actual wages incurred will take, actual variable overheads will take. But when it comes to fixed production overheads, we will recover it based on the normal production capacity. Okay, this you have learned in both the accounting standard and also in costing. So do you think these are going with the flow, and whatever we have discussed, with that you are able to solve these questions? Will not waste more time on these MCQs. So shall we go to IAS 10?
Yes, sir.